when I think about it, the argument for cutting interest rates below zero is essentially the same as an argument for cutting interest rates from any level. Lowering interest rates is expected to ease financial conditions, boost demand, reduce debt burden, helping overall to bring the economy to full employment. Going by previous recessions, when the Fed was able to cut interest rates by as much as 500 basis points, we would have now to go deeply into negative territory to achieve the same level of monetary easing. Fed is using different tools this time, though. Fed's chair Jay Powell and other Fed governors said multiple times that they believe that negative rates are not appropriate for the US, that their effect would be more harmful than beneficial. And the same applies to Bank of Canada. Stephen Poloz, in one of his last public appearances as governor of Bank of Canada, said we cut interest rates to as low as they could go. Negative rates are a tool with many shortcomings, so it should be used only when other tools are exhausted. Fed has the luxury, and Bank of Canada too, of learning from experience of other central banks, Bank of Japan, the ECB. The main concern about negative interest rates is their negative impact on banking sector, as it's very difficult for banks to pass negative interest rates to corporate depositors, even more difficult to retail savers. Many European bank analysts have found that cuts into negative interest rates have reduced banks' profitability. But it's not just the problem with hurting banks, but also, and maybe predominantly, the problem with contributing to deflationary mindset and potentially leading to even higher level of savings by the population, while at the same time, in the pockets of market participants, potentially leading to encouraging excessive risk-taking. Fortunately, it looks like negative interest rates may not be necessary this time. The tools the Fed and other central banks employed so far have been working very well. Markets regained a lot of liquidity and a lot of confidence, as evidenced both by tightening bid-ask spreads and tightening credit spreads and rising equity values. Tightening of financial conditions that we've seen particularly in March was entirely reversed, almost entirely reversed. And that's even before full-blown corporate purchase programs have kicked in. Our expectations are that should the so-called another shoe drop and the Fed need more stimulus, the Fed would engage first with other tools at its disposal. They could adjust, increase the size or scope of asset purchase program. They could manipulate their forward guidance. They could also engage, which is kind of our expectation, in yield curve control, in particular controlling the front part of the yield curve. So negative interest rates are not a 0% probability. However, when we imagine under what scenario the Fed would reconsider, we think that we would have to have the case of a recession when the dearth of demand persists way beyond the time that the virus is a problem. So demand too low for too long and unemployment too high. So taken together, these stringent conditions imply that the hurdle for negative Fed fund rates in North America is very high.